Making money from high-yield bonds used to be all about looking at the riskiest companies in corporate America and backing the right horses. But the market has changed substantially, resulting in a very different risk profile. To help us navigate the new landscape, I'm joined by Fraser Lundie, co-head of credit at Hermes Investment Management. Welcome, Fraser.
Thank you. Good morning.
If we turn to the first chart, a lot of people, when they think of high-yield bonds, they think about Michael Milken and the US LBO boom, but we can actually see it's a very different market today.
It absolutely is, and it essentially is something that used to be a small cap dominated market, which is now large cap, and it's been driven by consolidation and M&A and globalization, and you now have large corporates issuing in multi-currencies, where it's not just about, as you say, LBOs in America, it's about large companies right across the spectrum in terms of sectors, geographies, and ratings quality.
And I guess with that shift to a more global world, it's not just about stock picking anymore. You need a good handle on sovereign risk.
Yeah, and there's pros and cons to that, obviously.
Yeah.
I mean, the reason why M&A has taken shape from a globally diversified way is because ultimately that diversification is a good thing, but it does need to be priced when we're thinking about sovereign risk. And for that point, it's important to remember that sovereign risk doesn't start and stop at the line between EM and DM, because there is no line anymore. You have countries like Chile or Poland trading at half the level of something like Italy in terms of sovereign risk, and that needs to be understood. The other thing is that companies themselves, having operations all over the world, means that the sovereign risk of the headquarters actually is, in a lot of cases, not really telling you the story, and again, for good or bad, and that needs to be involving good bottom-up work and pricing of that sovereign, political and FX-related risk appropriately.
And in terms of valuations, we hear a lot about stretched valuations, but it's interesting to look at how that actually works from a risk and reward perspective. If we turn to our next chart, if you could explain in simple terms what this is showing us.
Yeah, I mean, I think, again, just thinking back to where high yield sits on the risk spectrum, it's basically slap bang in the middle between equities on one side, risk-free government bonds on the other. But within high yield, obviously, there's a very big difference between an income-focused double B credit and a very speculative triple C credit sitting right next door to equity. And with the latter, income is not enough. You need income and capital appreciation potential. So this graph basically explains, in broad terms, how much capital appreciation potential there is in the market.
Right.
A high number is bad, essentially.
Okay.
So the difference between the yield to maturity and the yield to worst being large would essentially dictate a poor convexity profile to the market, which means that the market cannot exhibit very much in the way of capital appreciation. You see this is particularly true right now when you look at the European and sterling denominated high yield markets, because they've been so driven by Draghi and by the search for yield and by the shortening duration thereof. But nevertheless, if you think about the context of this, the warning signs are there to some degree as to what happened in taper tantrum, perhaps. And it is something to be very aware of when you're thinking about investing in a triple C rated company. It might be a great company, but if you can't have access to capital appreciation, it probably isn't the right value.
So you need upside if you're taking on downside.
Essentially, yes. So you'll notice that for double Bs, and investment grade for that matter, it's less important because default risk is much less of a driver in that part of the market. But if you're buying something which is almost equity, you need it to go up.
Thank you so much for joining us today,
Thank you.
Fraser.